What if I told you that everything we've been warned about, recession, inflation, even economic collapse, is just the beginning? What if what's coming is far worse than anything we've seen in decades? Could your money be at risk right now? Is the next global financial meltdown already underway? And most importantly, are you prepared? In today's video, we dive into one of the most shocking warnings from Robert Kiyosaki, author of Rich Dad, Poor Dad. He believes the world is on the brink of an economic catastrophe, something worse than a recession. Stick with me, because I'm going to show you exactly why Kiyosaki is sounding the alarm, what you need to look out for, and how you can protect yourself before it's too late. What's happening now? The International Monetary Fund's dire warning. The International Monetary Fund, IMF, recently issued one of its most alarming warnings since the end of World War II. This isn't another recession warning, but something much worse. But why now? What are they seeing that's causing such alarm? Let's break it down. The IMF's main concern is that inflation is not only at record highs, but also more persistent and pervasive than anyone initially expected. Countries around the world, from the United States to Europe, are facing unprecedented rates of inflation. Let's take a look at the data. In the United States, inflation has soared to levels we haven't seen in 40 years. In Europe, energy prices are soaring due to geopolitical tensions, driving inflation even higher. But this is what is most worrying. In an effort to curb this runaway inflation, central banks are doing the only thing left in their toolbox, raising interest rates. And they're doing it aggressively. The Federal Reserve, for example, is raising interest rates at a pace not seen since the 1980s. The strategy is designed to discourage borrowing, which in turn should cool the economy and control inflation. But there's a catch. Every time the Federal Reserve or another central bank raises interest rates, it makes it harder for people and businesses to borrow money. This affects everything from buying homes and cars to financing businesses and investments. And as borrowing dries up, so does spending. That's where the real danger lies. Less spending means slower economic growth, which often leads to job losses, business closures, and yes, recession. And that's exactly what the IMF is warning us. But this is not just any recession. They're worried about something bigger, something that could shake the foundations of the entire global economy. Their latest global forecast point to a slowdown in growth in almost all major economies, and some regions could enter a prolonged recession. Consider the domino effect. When a major economy stumbles, be it the United States, China, or the European Union, the impact is felt around the world. We live in a globalized economy, which means that when one domino falls, the others follow. And what the IMF is now predicting is a global domino effect in which inflation, coupled with rising interest rates, will push several economies into recession and trigger a global financial crisis. What does that mean for you? It means that the money in your pocket is depreciating faster than ever. It means that prices for everyday goods, food, gas, utilities, will continue to rise while wages and job opportunities lag behind. It also means the financial safety net that many have taken for granted is shrinking rapidly. Well, the IMF has a long history of warning about economic recessions, but it doesn't issue such dire warnings unless it sees something really alarming on the horizon. So if this isn't just another recession, what is it? What we've seen before, drawing parallels to historical economic crashes. History may not repeat itself, but it certainly has its logic. To understand why the IMF's warning is so serious, we need to look back at some of the biggest economic collapses in history. The patterns are unmistakable, and we're seeing many of the same warning signs in the global economy right now. Let's start with the most infamous economic crisis of all time, the Great Depression of the 1930s. The Roaring Twenties had been a time of immense prosperity. Stock markets were soaring, people were borrowing money like never before, and the economy seemed unstoppable. But as we know, that euphoria was a house of cards. When the stock market crashed in 1929, the world economy was in shock. Banks failed, businesses closed, and millions of people were thrown out of work. The cause? A toxic mix of speculative investment, unsustainable debt, and above all, a lack of preparation for a recession. The 1970s witnessed another critical moment in economic history, the oil crisis. In 1973, OPEC, Organization of Petroleum Exporting Countries, imposed an embargo on oil exports, which caused prices to skyrocket. The effect was immediate. Energy costs skyrocketed, inflation soared, and economies around the world fell into recession. What's the lesson? When vital resources become scarce, the entire world economy suffers. Sound familiar? We are seeing something similar today with rising energy prices due to geopolitical tensions, especially in Europe. Then came 2008, one of the most devastating financial crises in modern history. It touched many of us close to home. What started as a housing bubble in the United States quickly turned into a full-blown global financial meltdown. Banks had lent recklessly, allowing people to take out mortgages they could not afford. When housing prices began to fall, millions of people defaulted on their loans, and the banking system, built on layers of risky debt, collapsed. Governments were forced to intervene with massive bailouts to prevent a total economic collapse. But here's the key. In each of these cases, the warning signs were there, but few people took them seriously. In the 1930s, people ignored unsustainable debt levels. In the 1970s, governments underestimated the impact of oil dependence. And in 2008, housing market risks were overlooked because the economy appeared strong on the surface. So, where are we today? We see echoes of all these crises in our current situation. Debt levels, both personal and national, are at record highs. The energy crisis is back in the spotlight, exacerbated by the conflict between Russia and Ukraine and disruptions in global supply chains. And let's not forget that speculative bubbles are forming again, especially in sectors such as cryptocurrencies, real estate, and even the stock market. All the ingredients are in place for another massive recession. Soaring inflation, aggressive central bank policies, and a global economy that is more interconnected than ever. The IMF warns that if we do not take these signals seriously, we could be heading for something far worse than a simple recession. So are we about to repeat history, or are we headed for something even more dangerous? The Federal Reserve and the bond market, a fragile balance. Let's now talk about one of the key players in this crisis, the Federal Reserve. For those unfamiliar, the Fed's main job is to manage the U.S. economy by controlling interest rates and the money supply. But right now, the Fed is in a delicate balance, and the decisions it makes in the coming months could either stabilize the economy or send it into a tailspin. So what's the dilemma? The Federal Reserve is trying to fight inflation. To do so, it has raised interest rates at the fastest pace in decades. This is supposed to cool the economy by making borrowing more expensive, which in turn slows consumer spending and investment. But here's the catch. Higher interest rates don't just affect consumers and businesses. They also have a huge impact on a crucial but often overlooked part of the economy, the bond market. What's the bond market? For those unfamiliar, bonds are essentially promissory notes issued by governments and corporations. When you buy a bond, you're lending money to the issuer in exchange for interest payments. Bonds are considered one of the safest investments, especially government bonds, because they offer stable yields. But when interest rates rise, the value of existing bonds falls. This is because new bonds are issued at higher interest rates, making older bonds with lower interest rates less attractive to investors. This creates a big problem for bondholders, including pensions, mutual funds, and even governments that depend on the bond market for stability. So why does it matter? Why should you care about the bond market, especially if you don't invest directly in bonds? Here's the scary part. When the bond market becomes unstable, it can set off a chain reaction that destabilizes the entire financial system. And we are already seeing signs that this is happening. In the UK, for example, recent turbulence in the bond market led to the near collapse of pension funds. The Bank of England had to intervene with emergency measures to avert a major financial crisis. But it's not just in the UK, it's happening all over the world. When central banks raise interest rates, bonds that were once considered safe investments suddenly look much riskier. And when large investors, such as pension funds and banks, start losing money on bonds, they may be forced to sell other assets, such as stocks, real estate, and even cryptocurrencies, to cover their losses. This could trigger widespread sell-offs in multiple markets, amplifying financial chaos. The Fed knows this, but it is in a difficult position. If they don't keep raising interest rates, inflation will continue to erode the value of their money. But if they keep raising rates, they risk collapsing the bond market, which could send shockwaves throughout the global economy. It's a lose-lose situation. So, what are the possible outcomes? The first possibility is that the Fed remains unmoved and continues to raise rates to fight inflation. In this case, we are likely to see more volatility in the bond market and, by extension, the stock market. This could lead to a slow but steady economic slowdown as borrowing becomes more expensive and investors move away from riskier assets. The second possibility is that the Fed may be forced to back off. If the bond market becomes too unstable, or if we start to see large financial institutions on the verge of collapse, the Fed may have to stop raising rates or even lower them. This is what is called a Fed pivot. While it might bring short-term relief to financial markets, it would probably drive inflation back out of control. In any case, the average citizen will feel the effects, whether through job losses, reduced retirement savings, or skyrocketing prices of everyday goods. But here's where things get even more complicated. The bond market doesn't just affect investors and governments. It also has a direct impact on things like mortgage rates, student loans, and even credit card interest rates. When the bond market falters, so does the cost of borrowing money, and that affects everyone. So even if you don't actively follow the bond market, you can be sure it's affecting you right now. Prepare for what's coming. Here's what you need to do. So how can you protect yourself and your family from what's coming? If Kiyosaki is right, and all the signs point to a major economic downturn, there are some steps you can take to protect your finances. First and foremost, diversify. This can't be stressed enough. If you have all your money in one type of investment, such as stocks, you're doomed to disaster. In times of economic crisis, those who have diversified their portfolios are the ones who survive financially. Kiyosaki often recommends investing some of your money in assets that hold their value in times of inflation, such as gold, silver, and even cryptocurrencies like Bitcoin. Why? Because these assets have historically acted as a hedge against inflation. When the dollar weakens and prices rise, gold and silver tend to appreciate in value. Cryptocurrencies, while volatile, are increasingly seen as an alternative investment that could hold up well in times of economic instability. Second, cut back on unnecessary spending. Now is not the time to be reckless with money. Take a hard look at your budget, eliminate non-essential expenses, and start saving as much as you can. Every dollar saved today can make a difference if things take a turn for the worse. Third, create an emergency fund. It's your safety net. If the economy crashes and you lose your job or your income goes down, having a few months of expenses saved can make all the difference. Finally, educate yourself. The more you know about the economy, the better prepared you'll be to make smart financial decisions. Follow the news, read books, listen to podcasts, and make sure you understand what's going on around you. Look, I know all of this may seem overwhelming. The thought of another economic downturn, even worse than a recession, can be frightening. But it doesn't have to happen to you. By taking action now, diversifying your investments, cutting unnecessary expenses, and educating yourself, you can protect yourself from the worst of what's to come. The IMF and experts like Robert Kiyosaki have given us a clear warning. The question now is, will you listen or will you wait until it is too late? The choice is yours. If you found this video helpful, hit the like button, subscribe to the channel, and turn on notifications. We have more videos like this on the way, and trust me, you won't want to miss what we'll be talking about next. And don't forget to check out the links in the description below for resources that can help you stay financially secure in these tough times. On your screen, you will now see more videos that I have prepared exclusively for your learning. Click on any of them to discover more strategies that can secure your financial future. Thank you for watching, and remember that the future of your wealth is in your hands. Take action today to prepare for what lies ahead. See you in the next video.